How are you now? Broadcasting from the VFS studios at Nelson's Point in Sydney. You're listening to the all-new Bib Show, Season 6, Episode 4, I think. It's almost the end of the year. We're almost there. One step at a time. Might be one more show at the end of the year. I've got a good guest cooked up for next week. Don't forget, hit subscribe wherever you get your podcasts. A reminder, all the financial information in this podcast is generally nature only. Speak to a professional advisor about your needs. That is me as well. Coincidentally, I am James Whelan, investment manager here at VFS Group. Paul Colgan is back from Davos. He went to the other office. He didn't come to the Milsons Point one. We hope to catch him next week, maybe next year. Good on you, Paul, if you're listening. This episode is being recorded in Sydney on the 2nd of December 2022 AD. The time is 10:55 in the AM Australian Eastern Daylight Time. My guest today is our first guest that we've ever had from Bloomberg, and that's a really big thing because getting you guys is like pulling hen's teeth, and it's a really special one because it's going to talk about something that I think that a lot of people have become experts in over the last couple of years, especially with raising yields. Now, let me get this straight. So yields go up and bonds go down. I have to say that every single time, the same way that everyone in every article that's ever written has to say it as well. He's the chief rates correspondent with Bloomberg, 20 years, a veteran, if you'll excuse that word, with Bloomberg, formerly of some fun stuff, which we might talk about as well. Ladies and gentlemen, my honour to welcome Garfield Reynolds to the Bip Show. Garfield, how are you now?
I'm good, thanks, James. Thanks a lot for that voluminous introduction.
I do have a tendency to make it a little bit wordy, don't I? Sorry about that. Now, let's get straight into it. Thanks for joining us on this one. And look, there is lots of things that have been going on in this market. Funnily enough, that from the time that we started talking about you coming on the show. Oh, also, this is your external media debut.
That's correct.
Congratulations. Well done. And I hope that the Bip Show is a good friendly place for you to get started on this external side of things. To talk about some really easy stuff and maybe some really hard stuff as well. So I want to talk about what's going on lately with the Fed. I want to talk about data points that may not be as obvious to people. So what maybe we should be looking at on the sides that people don't have on the headlines, and maybe some other stuff about your process and how you get to the decisions that you get to as well. So first off, since we started organising this podcast, a lot has changed. I think that we can say, would you call this a pivot? Is it official, or is this a pivot to pivot? Is it a plan to pivot?
Well, more than anything else, it's been a pivot in the market. Yeah, the market has gone, okay, that's it. The peak is in for yields. The Fed is about to go from being nasty and restrictive to being kind and accommodative. That's the pivot that I see taking place so far. What the Fed is doing is a little bit less of a pivot than maybe just a slight adjustment. I thought it was extremely interesting. We had very, very strong rallies in bonds and stocks and everything against the US dollar after Powell spoke. What Powell did was he said, it may be time to moderate, i.e. we may only go 50 basis points rather than 75 basis points in December, which was what everybody was pricing in they would do. But, and this is the bit where the market stopped listening, but Powell said, going forward, we actually think we might have to go higher and more restrictive and keep it there for longer than we had been expecting before. So it sounded like Powell was trying to warn the market, look, just because we slow down to 50 doesn't mean we stop being restrictive. Yeah. In fact, we might have to be more restrictive than you're all thinking. But the market just heard we might go 50 and went, hallelujah.
Yeah, I'm not 100% committed to a rally at this particular time myself. I think that we need to just have a look at the complacency there is in the market. And also the next thing that happens, I believe, is that we're in a bad news is good news situation at the moment. Disaster strikes shortly, I believe, when bad news is bad news. That's potentially the next stage. When does Powell blink? That's the question.
Well, and the problem is that when he does, that's when the excrement is hitting the air conditioner.
Yes.
To keep it PG.
Yeah, we don't have Ken Vexler on the show anymore, so we don't get the complaints that we used to have about the swearing. It's okay.
So Powell blinks when US jobless rate goes to 4%,
right,
or above, or when inflation comes down, under 4% on a PCE basis. The main metric the Fed looks at. That's when Powell is going to blink and say, okay, we can stop. It's quite a contrast to the RBA. The RBA looks like it's ready to stop pretty darn soon.
Yeah.
Even when we've got some fairly elevated inflation, there are some particular characteristics of the Australian economy that help to explain that. But Powell is frantically worried that he does not want to be remembered as the next Burns. He wants to be remembered as Volcker. Burns was the Fed president before Volcker, who went up and down and then had to go up and down and up. Powell wants to be sure that when he stops, he's done the business, that he's not going to have to worry about inflation coming back.
Yep.
So it's going to take a while before he blinks. And when he does, that's when it's going to get really interesting, because if we get inflation come down without a savage recession, that will be the first time that's happened, in a very long time, certainly in the modern world, if we're talking post-1960s.
Yeah, I was looking at some historical data of when the Fed has stopped their hiking process. What happens to markets after that stage is actually quite devastating. Historically, did you have any stats on that, or do you want to? I can just rattle off a few numbers.
If you want to rattle off, I hadn't looked perhaps as precisely as you have, but of course the classic was, the Fed stopped hiking. When at about like mid 2008, so that ended well. Yeah. And even COVID obscures it a bit, but they stopped hiking and turned to cutting in end of 2018, beginning of 2019. Yeah. The world economy was going well and truly south at that stage. We had the bond market looked like it actually anticipated COVID, but what it was doing was it was anticipating that the world economy was going to be in a very bad way.
Yeah. There was an inversion on the curve, wasn't there? I remember them. I'm trying to remember who it was. It might have been Heinrich Larsen, potentially. I'm trying to remember which commentator that was on Macro Voices, a really good podcast that I listened to, saying that the yield curve has once again predicted a recession. Just there's absolutely no reason as to how it managed to predict this one out of where it came from. Is it?
But there was one coming. You think in Australia, and for all that we like to think we're a bit isolated and special, Australia is actually a very, very open economy. It's very exposed to international trends, and the RBA was forced to turn around and cut rates in 2019 when that was totally not the plan. The plan when Phil Lowe took over from Stevens was Stevens did what they all thought was going to be the last rate cut and left it for Phil to hold rates and then start hiking once the economy went back to what they thought it was supposed to go back to, a more normal, robust Australian economy. And instead, it just kept on sagging. Because, again, one of the things that's kind of been obscured both by COVID and by Trump, I would argue, is the way that the US-China relationship soured from a win-win, each side thinks they can help the other, to a zero-sum game. That's a massive shift for the entire world. The world's two biggest economies went from working hand in hand. Yes, they got a little bit sweaty. Yes, they gripped each other's hands a little bit.
Someone's hand was a bit bigger in that.
That's right. Two, bare knuckles ready.
Someone has to win and someone has to lose.
Yeah, and that's a massive change for the global economy, massive change for each of those economies. And then along came COVID and wiped everything out anyway.
Yeah, and made everyone even more separated. Actually, here's a good question for you. Is globalization dead?
No, it's not dead, but it is no longer reigning supreme. Much the way that the efficient markets thesis has gone the way that's faded away and perhaps died, or at least it's in suspended animation until the central banks get out of the way. That way.
Yeah.
But also, if you look, these ideas don't go away. You actually had Fukuyama declaring the end of history because communism had proven to be a bankrupt ideology was the idea. Well, there's a fellow called Xi Jinping who might want to contest that ideology is alive and well in the world's second largest economy. So it took a step back, but that basic idea, that contest between the ideology of free market democracy, however far or close we might be to actually practicing that in what we like to call the West, and a different way of doing things, like what Russia does, or Turkey, for example, definitely has a different approach to democracy and to markets. Where you have a president who he's still very much, his ideology is I'm doing this for my people, for the Turkish people, and I'm going to do things like tell the central bank to cut interest rates despite inflation because I think that's what's going to help the people out. And I'm not going to trust the market. And I'm not necessarily going to trust the people. So it's a different approach.
Trust any economists either, apparently.
No.
What do you have a take on China going forward for the next few years? I mean, the People's Congress is behind us now. My prediction was that COVID zero would be lifted fairly shortly afterwards. I've been wrong about that. It looks like it now is on the way of being signalled. I still say it's not done until it's done. What's your take on the future of China?
Well, so my take on the future of China is that China's not going to come back to the future as it was. It's not going to be the China that everybody remembers from the 2000s, 2010s, because the population stopped growing. And I think that actually helps to explain a lot of the COVID zero policy. Fetishization is kind of the wrong word, but the strength with which the regime has been holding to COVID zero is because they're really, really worried about their population. It stopped growing. It's even starting to potentially decline. That means the growth model has to change. That means you want to safeguard your people. They're China's main resource, and they're a more limited resource going forward than they have been. So with that, I mean, the flip side of it is that they now know that COVID zero can't work, not with Omicron coming along. And Omicron both means you can't use COVID zero to shut it down, it looks like, because they have not been able to do that. I'm no medical expert, but like looking at them on the ground, they're facing an outbreak despite COVID zero. So it makes sense you would move on from it. I think they'll move on fairly slowly. It's not going to be the way we had it in the West, it looks like, or in Australia and Europe and so on, where at some stage you go, okay, we've got the vaccines, we've got the plans in place. We're now dealing with a variant that is very, very infectious, but not particularly lethal. It is lethal for some. Let's not lose sight of that. Not particularly lethal.
We had Dr. Gigi Foster on the show. The victory lap of hers was sensational. Very calm.
But so that being the case, I don't expect China to do what we did here and just say, okay, that's it, no more restrictions. They will still at times revert to restrictions. They will help to keep things under control. And one of the things actually that you were discussing on that previous program was the idea that here in Australia, governments are quite happy that they've got that dictatorial power during COVID. Well, you can multiply that by many amounts in China. China's instinct is to control people. And they were already setting up a deep surveillance state there. COVID advanced that. They're not going to give up on that. They're not going to give up on control being what they want. So I think opening is coming, but I think it's going to be slower than a lot of people think.
Yeah, slower and a different looking China from anything that we've experienced before. But not unsurprisingly. It's exactly in line of people's, I hate to say it, exactly in line with people's worst fears for that country.
Well, I think it's actually sort of second worst fears. The worst fear has to be that I think that you get total chaos there, because who knows what might go on there. I mean, that's one of my fears for what might happen with Russia.
Good point. Yeah, about that. Did you want to talk about Russia?
Well, I mean, let's stick with Powell for the.
Okay. Sorry. We're off track. Yeah, we can do that. Okay. So, on your note yesterday, you mentioned the Fed's favorite yield curve, what they like to look at. Why is that important? What is it? And run us through.
Okay. Well, I mean, this was something that you never know with central bankers because they say one thing and do the other in the end. But
look at our own products.
Back in March, when the classic yield curve, the 2s, 10s, looked like it was going to invert, and that's got a pretty good track record of being a predictor of recessions, although it comes with a lag. It's not like as soon as it inverts, you go, we're in recession. It's like we're heading for one. So Powell pointed to research by the Fed that showed that if you look at the gap between the current 3-month T-bill rate and where the market expects that T-bill rate to be in a year and a half.
Okay.
So if that inverts, the Fed research shows that means that you are going to have a recession very soon, because the market is certain that within 18 months, the Federal Reserve will be cutting interest rates. And the Federal Reserve would only be cutting interest rates if there's a recession.
Okay.
So it's a little bit circular. I was a little bit skeptical of them highlighting that, because to some extent, it sounds to me like a metric that they have a lot of influence over, because of their guidance.
Because they can say there's going to be a recession in 18 months. Effectively, the market would believe them.
Yeah. But then again, at the moment, that curve is pretty deeply inverted.
Yeah.
And Powell was out there. One of the things that helped stocks in particular rally, it seems, was he was sounding optimistic about what so-called soft landing, which is no recession. So they still think they can cure inflation without a recession, and part of that's because the jobs market is still pretty damn robust over there.
Yeah.
So they're thinking we can do this without a recession. The bond market is saying no chance. You're getting a recession. All of the yield curves are deeply inverted, including that Powell one. And we even saw one in a lot of ways, and this is one of the things that I think people lose sight of. The real danger on the economic front isn't when the 2s, 10s inverts. It's when it's inverted deeply and then it starts coming roaring back up.
Why is that?
Well, because that's when that happens, when you get that pivot. So the Fed's done so much that 2-year yields start dropping.
Yeah.
Because the Fed's not going to be hiking rates anymore.
Yeah.
And then they drop further, and you get back to a situation where the central bank is seen as having to prioritize growth over inflation. So that means 10-year yields stay where they are or go up.
Yeah.
2-year yields come down, and you get back from deeply inverted, you get back towards zero. That usually only happens, when I looked at it, when you are in recession.
When something's broken.
Yeah, something's broken.
Yeah.
That's it.
Do you think that Powell still stands by? I think one of the ones that came out of the big. I mean, there's been a couple of months of what I call rug pull months. The media, I'm not pointing any fingers. The media gets us all juiced up, saying that okay, this is it. They're finally going to pivot. We've maybe seen inflation behind us. Let's all put all of our eggs into a Powell speech. We all get up in the middle of the night or first thing in the morning to listen to this, and he comes out and says we're going to keep on aggressively raising rates. What the hell are you all talking about?
Yeah.
Stop listening to those guys. Listen to me. And then the market gets a hit, and we sort of go through the situation that's there. In his last chit chat that he had, what was it? Beginning of November. Yeah, it would have been. Anyway, in his last chit chat, he did have sort of this push with it's easier for me to fix something that breaks than it is for us to continue perpetuating this nonsense cycle that we're in of low rates and things keep on going. Do you think he's going to be pushing with that? That I think should be his mantra. But
yeah, I think he's pretty committed to that. And it's not just him too. I mean, that's one of the things, it can be a little bit difficult for people in Australia to quite get their heads around here. You've got this board of Fed governors, many of whom are this board of Fed officials. Many of them are governors or are presidents of particular regional banks, and they actually sort of answer to their area. And there's a quasi-political role to it that you don't have here, and you don't have, for that matter, with the Bank of England or even the ECB, despite the fact that they've got central bankers from different countries there. But there's a more collegial aspect, whereas a bit more of like competing mouthpieces in the Fed. So they're all very worried about inflation, about it staying out of control. And I think there is a subtext too there that nobody really wants to go back to zero rates and QE because there's an appreciation that there are long-term consequences for that. So there's an argument to be made that the Fed is going to be a lot different to the Fed we're all used to, and that they will keep rates restrictive until they're absolutely sure, because they want to set up, they're hoping for this soft landing, they're hoping for a scenario where you go back to an economy where like a 3 to 4% 10-year US yield is normal. We spent so much time over the last 10, 15 years looking at treasury yields at what between 1 and 2% and going, this is crazy. This makes no sense. You would watch it and go, how can you say you're heading for a healthy economy when you've got a yield that is that low?
Yeah.
So I think there's some appreciation of that in there for central bankers. We'll see. Yeah, we'll see if they can stay the course.
Yeah. Okay. So speaking of data points, what are there any other sort of around the world things that you would be looking at now to tell you when not necessarily when things are broken, but sort of the stuff that people should have on their watch list or at least on their radars to know where the world is heading, where the economy is coming, where potentially markets are going as well?
Yeah. Well, I mean, I pay a lot of attention to what's going on in the world of FX and cross-currency moves and so on. So there are these things called basis swaps, which is how investors can move money between currencies and hedge not only their exchange rate risk, but also their interest rate risk.
Yep.
So when they gap wide or narrow, that can tell you a lot about what's going on. We had some very extraordinary moves in those around the end of June and the end of September as we came into the end of this year. So there's still a fair bit of apprehension about the end of this year. Those have actually come off a bit lately, which may be a good sign, or it may be just that people, they were using them around the 3 month and now they're dangling.
Okay.
But what's going on in FX forwards, which have also been very elevated, and how those FX forwards translate into hedging costs. So one of the things that's been going on, Japanese investors have been staying away from a lot of markets that they usually go into. They're really important because they have a lot of money to deploy, and they're very willing to deploy it and put it in bulk in various places. That moves currencies, moves yields. FX hedging costs are still at the point where if a Japanese life insurer wants to buy a 10-year treasury, they get a negative yield if they hedge it against going to the yen. So
it breaks my head thinking about go on.
Yeah.
Go on. Yeah. You've got to go through that again. If they want to hedge a long treasury position, it's going to be negative.
It's going to be negative.
Okay.
Yeah. So they would only
do that.
Well, you might do it by now if you think that, because these guys play the long game. So if you think that going forward, that hedging cost is going to ease away, and you're going to get actual capital gains. You're going to get yields come down, so you get the capital gain that can outweigh that hedging cost. Well, you might start to go into that. You might also instead decide to go into Aussie or into Europe because of that. So that's one thing I like to keep a pretty close eye on. I think the other thing that's a little bit underappreciated in part of what's been going on recently is just the optics of what's been happening with yields for bonds. Those are fat enough now again that, in fact, if you worry about a bond sell-off, US 2-year yields, I think, are still north of 4%.
Mm-hmm.
If you worry about, oh my God, what if they were to sell off the way they sold off this year and the 2-year yield was to go to 6%? Well, if you sit and hold that for a year, you still made money. You didn't make a lot of money, but you still made money because the yield offers protection.
Yeah.
So I think that's one of the things that's starting to happen with bonds in general. Part of why they're showing so much resilience, even at a time when central banks are jumping all over the place and there are still some inflation concerns and so on. And that's actually fed through into stocks as well, because they've looked at it and said, well, bond yields aren't getting much higher because people are buying them. So then we're all right. Tech stocks rally when bond yields fall. I never quite got that myself as a sort of long-term thesis.
It's all about this forward cash flow analysis with the cost of money and things that go on, which is really difficult to explain to people who aren't involved in the industry. It's difficult for me to explain. I'm supposed to be the guy who can explain everything. That's sort of made that my niche. I can't adequately explain this to people. It's just something that just happens. I think that it's also when the stability of the yield comes in that it's not going to go much higher. It might go a little bit higher. But if you can now set it and say, I know what I can now value this company at, or what their money is going to be worth going forward. It does mean that you can then invest with more confidence, and that's the idea. Is that people just go, markets hate uncertainty. If you're uncertain, I can't invest as much into it. Now I'm certain that yes, that rate is going to stay there, but at least I'm certain of it, and that's the difference that investors have.
Fair enough.
That's well, no.
Yeah. No. And yeah, I mean, the other thing I do a lot of looking at overnight index swaps, which are that's when investors, banks, companies, whatever, you've got a fixed rate and you want to solve it for a floating rate or vice versa.
Yep.
And overnight index swaps are indexed to essentially cash rates. So it tells you a lot about where people think cash rates are going to go. And then you can look at, well, where are those relative to things like the bank bill rate here, which is the OIS is where's the RBA's rate going to be?
Yep.
So bank bill, okay, that's the basis of the private sector cost of money. So how are those moving? Or also what's known as floating rate agreements, which are similar sorts of things on the banking side, but to do with actual just straight floating rates. So if those get out of whack with OIS, and they are out of whack at the moment, especially for the US, they got very elevated indeed. They've come back down a bit, but they're still about where they were sitting in March, which was just after the Russia invasion and just before the Fed started hiking rates. So that says to me there's a lot of risk in the banking sector that people aren't necessarily taking too much notice of. And but maybe they're right to be complacent about it. Maybe they're not.
Yeah, okay. Well, those are the data points. Now, speaking on that one, and I know that we're pushed for time here, but you're 20 years at Bloomberg. So apart from that, so you've mentioned some of the data points that you hit on. I'm always looking to at my process and my methods and the way that I do my job and what I'm looking at. So it's one thing to have those things that you look at. Do you have a process coming together with an idea or a thesis that you'd like to put out for Bloomberg, and maybe you could just give us some sort of an insight into how that is, and we can get something off that? Yeah,
well, I think I'm extraordinarily fortunate, like with covering the side of the industry I do, rates and FX, that I'm in Sydney, because you could say you'd be better off in New Zealand, but it's awfully cold and isolated out there.
Yeah, right.
But you get to see the start of the day. So I come in and I say, okay, this is what went on overnight.
Yeah.
And then fresh start, especially every Monday, they speak both with FX and with rates. What's going on? You sort of step back a bit, because although Treasury futures and Treasuries trade in the Asian day, it's pretty thin. So you can take a little bit of a longer view, not worry, at least initially, too much about some stops that might be taken out, or is this move? Or you can sort of look, okay, we had this big move overnight. How much of that was real? How much of it was positioning?
Yeah.
Right? Part of what went on, I argued, with the post-Powell move was that you had yields are backed up because of corporate bond sales, because you sell treasuries to hedge corporate bond flows. You also have a very strong short position that hedge funds had taken going into the month end, and you had an index roll, which meant investors had to add duration in the coming month, and it's very obvious that some had left that to the last moment. So they're piling in. Duration is just a fancy term for buying longer-term bonds.
Yeah. Thanks, Marty. So Marty Wetton, who is the one who reminds me of that every single time.
Yeah.
It's okay. He's listening. I know he is.
Yeah. So all of that helped to exacerbate the move. So you can look at that sort of thing.
Yeah.
And I am particularly somebody who likes to look on a sort of anything from a 1 to 12 month horizon. Where are we, and sort of where might we go? So charts are actually an enormous part of like how I construct things. Sometimes taking a look at correlations, sometimes just taking a look at patterns or at spreads. Is this something that it's the first time we've seen a spread like this? Wasn't me who came across it, was one of my colleagues actually. I thought it was very interesting. Run a correlation between Treasury 10-year futures and S&P E-minis. You want to run those two because they trade on the same sort of timetable.
Oh, yeah.
Yep. And the correlation between the two was the strongest since 2012, and amongst the strongest ever. That's a 60-day percentage change correlation study.
Love that stuff.
Yeah. And you just go, and it's one of those head scratches, like, well, what does it mean? Because it's only happened once before when it got this high.
Yeah.
And that was in 2012. Well, 2012, there's one thing that's very similar between 2012 and now, and that is there was one big issue that markets were stressing over. Now it's the Fed pivot. Back then it was, is the euro going to collapse?
I remember that.
Yeah. So you've got that moment, and so everybody's moving. It's like, one way or the other.
2012 it was, yeah. Okay, so I mean, and there's only one historical moment when that's happened. What was it? That was the E-mini futures.
E-mini futures with the 10-year futures for treasuries.
Okay.
Yeah, look at those two because they both trade 23 hours a day. Like if you try doing it with, say, US yields and the S&P 500 cash index, so which would be then is the inverse correlation, but US 10-year yields trade about 22 hours a day. The S&P cash only trades 8.
Yeah.
So then you get, and you get a
there's a lot of fresh air. There's a lot of fresh air when they're not next to each other. That's the way to go. That's very smart. I like that. Anything else? So to sort of go through, we've talked about your methods. We've talked about, I had a little checklist of things that I want to do here. Talked about yield curves. One day we will stop talking about yield curves.
Oh,
I'm going to get so drunk. Anything else to add? Otherwise, I'm going to have to close it off here.
No, I think that's it. Yeah.
Okay. Well, thank you so much for joining us, Chief Rates Correspondent with Bloomberg, Garfield Reynolds. Cheers.
Thanks, James. It's been a pleasure.
We're sponsored by, I think I can say it now, we are and will be sponsored by Global X ETF providers going forward. So really happy to have that sponsor on board. I'm going to do a proper ad next time, and I really look forward to working with them as well. Thanks for that. Thanks for that, Garfield. Have yourself a great day.
Cheers.
You can find us on iTunes at The BIP Show or wherever you get your podcasts. We're on Twitter at @the_BIP_show, and we're on Facebook too. Just search for The BIP Show. I've got a website. Just Google Whelan Capital. It's got all of the links and all of the documents that you want to know. Individually, I am at James Whelan 42 on Twitter. The show is produced by whoever I could find on the day. Thank you very much. We'll catch you next time.